Chapter 16 is all about long-run growth and unemployment, and it tries to answer one of the seeming paradoxes of macroeconomics, which is that as we replace workers with capital and are able to produce more with every hour worked, why doesn't the unemployment rate go up? Or as we kind of think about it these days, are the robots going to come take all of our jobs, right? And we talked about creative destruction a little bit already in chapter 2 with the idea that companies that are able to adopt new technology, develop new processes, are the ones that thrive and survive, and companies that are unable to do that are the ones that go out of business. But when we have these new technologies and these new productive possibilities, a lot of people get put out of work, right? And we often worry, and we have worried over the last 200 or 300 years, that those people are not going to find new jobs. And so we're going to look at the data, we're going to look at growth and unemployment, but we're also going to look at institutions. And what we're going to see is that institutions and policies in labor markets are really what help explain the differences in long-run unemployment. So this graph just shows sort of the unemployment rate over time for the last 55 years in a number of different countries. And we can see that despite the fact that the economies, all of these economies have grown substantially since 1960, the unemployment rates have been more or less constant with ups and downs due to the business cycle and longer term ups and downs due to demographics. And so the question then is really, how does this occur? If we are coming up with new production technologies, how is it that the unemployment rate doesn't always just continue to rise? Well, we can sort of look at long run outcomes. So instead of looking at the unemployment rate in a month or a year, we can look at average annual unemployment rates and real wage growth. So the horizontal axis here gives us the unemployment rate averages for 1970 to 2011. And you can see it ranges from sort of 3 to 4% for Japan and Norway up to about 15% for Spain, with most countries falling between about 5 and 10%. And then on the vertical axis here, we have real wage growth. So we have average annual growth from the same period, 1970 to 2011. And you can see that the US and Canada here are lower, around 1% per year, whereas Finland and Spain and Norway are closer to 3%. Part of that, for the US at least, is that we were one of the first countries to grow really quickly, but part of it also is the different institutions that the countries have in their labor markets. So we've talked about technological progress a fair amount in chapter 2, right? We said, all right, firms can earn innovation rents, all right? And an innovation rent means that they can earn positive profits by innovating. And that innovation can be a new product or service. It can be a new process, right? So that they can make their products more cheaply. And firms that are unable to adopt these new innovations are likely to fail. And that's the process we call creative destruction or Schumpeterian growth. And so the way we often think about technological progress is the adoption of new technologies and the use of capital goods. And often what happens is that we sort of, when the new technology exists or is invented, we have to upgrade our capital goods, and that allows us to produce more per hour of labor, right? So those new technologies require new machines. And this is the process that allows for sustained growth, right? This is the process that we talked about in chapter 1 that allows people to enjoy a much higher standard of living than they used to. So how do we model that technological progress? Well, we've talked a little bit about the production function, and you probably did that in microeconomics as well. And so the production function, which we'll go into in more detail in the next slide, looks at capital per worker on the horizontal axis and output per worker on the vertical axis. And adding more capital allows workers to produce more, but at a diminishing return, right? So we say there's diminishing marginal returns to capital so that each additional unit of capital adds a little bit less than the last unit of capital. And a new technology we model as being a shift up in the production function, right? So when we move from B to A, we're adding more capital, but when we move from B to C, we're both adding more capital, but also adding a new technology. So let's think about how this works. So here we have capital equipment per worker on the horizontal axis and output per worker on the vertical axis. And we see that concave production function that gives us the diminishing marginal returns to capital. So at a point A, we can see that there's not too much more to be gained by adding capital, right? Remember, the marginal product of capital is the slope, and so it's the change in output per worker divided by the change in capital per worker. And so at point A, that slope is pretty flat. Down here, the slope is pretty steep, right? And so if you think about, for instance, the difference between a country like the United States and China, the United States workers have much more capital, so there's less to be gained by adding more capital, whereas in China they still have significantly less capital than the US, and so there's more to gain by adding additional capital. When we have technological progress, right, when we introduce a new technology, then we get a shift up in our production function. So that's this red production function. So that allows us to do more with any dollar value of capital. And you can think of that as really just new ideas, right? That's the capturing the value of new ideas in that production function. So if we think about a point B, on our old production function where we had $20,000 of capital per worker and we were producing $15,000 of output per worker. And then we move up to point C, where we have $30,000 of capital per worker and are producing $22,500 of output per worker. Those are on different production functions and so have different technologies, but they actually have the same average product of capital, right? Which is just capital or output divided by capital. So in this case, 15 divided by 20 or 22.5 divided by 30. And we know they have the same average product of capital because they are on the same ray coming out of the origin. So any points that are along the same ray will have the same average product of capital. So if we look at technological progress over time, we can see both increases in capital per worker and also shifts up in the production process, right? So we see, for instance, the green line is Japan. The orange reddish line is the United States. You can see there was a big shift up here. The blue line is the UK, so they had both movement along in terms of capital per worker, but then also shifts up. Taiwan is the purple-ish line. And so what we're seeing, since we don't actually see the whole production process, what we're seeing is a combination of both capital accumulation and technological progress. And of course, that's always a challenge in the models and in the data, is that both of those things are going on at the same time.